Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Tisa, welcome. Glad to have you here with us today.
Thanks, Paul. Great to see you.
Great. And Bruno, good to see you.
Good to see you too.
Yeah, and we've got a great episode with from a great institution. And but before we get there, I just happened to pull up Limmer sales stats. It's really interesting for second quarter. I don't know, Tisa, do you see those?
Yes, we were looking at them actually in a session yesterday.
Yeah, it's interesting. It's I think the quarter over quarter, I think the industry was up 5% according to Limmer, but Bruno Rylas were up 20%. Really interesting. Really interesting market dynamics here. So, but I won't steal your thunder. We've got a great person here to give us some really good industry perspective, not necessarily on sales, but other aspects of the business. So, Bruno, do you want to do the honors?
It would be a pleasure to introduce Jason Opper. Jason Opper is an associate director at AM Best in the credit rating and criterion research department. I've had the pleasure to work with Jason in the past, and I'm looking forward to a great conversation. He's responsible for a lot of the industry studies that AM Best publishes. So we have a lot to cover today. So we'll get right into. Welcome, Jason.
Bruno, thank you. Paul, everybody, thank you. Great being here.
So we've seen so many shifts in the industry, and we hear headlines on sales, on investment portfolios, on reinsurance, and we'll try to talk about every single one of those topics. But in terms of sales, why you just Paul, you just brought those that topic up first. So why don't we kick that one up? So Jason, according to your research, according to your observations, what do you see in terms of trends among various annuities, in terms of like deferred annuities, MICAs, RILAs, FIAs? And what do you see? What kind of trends are you seeing, and what are the the driving factors that are supporting those trends over the last 5-10 years?
Yeah, sure. Again, thanks for having me. There's definitely a whole lot going on within the annuity space, right? Interest rates have risen over the last couple of years compared to, over the last decade or so. The very low and very prolonged interest rate environment has now ticked higher, which makes annuity products more appealing to consumers, especially when compared to, say, similar product offerings from banks, say particularly like 5-year CDs, which could be comparable to some annuity products, as you mentioned before. At the same time, you have a lot of newer capital entering the market. You have private equity companies entering, you have some asset managers entering the market. And along with that brings a lot of investment expertise to some companies. And that has also led some competitors to also seek some outside managers, investment managers, to bump up their yield, which in turn helps those companies offer more competitive crediting rates to consumers. Product specific, we've seen growth in many various products. There are some risk more involved with other products, such as index linked products, and the volatility that we've seen over the last year and a half, 2 years or so. But yeah, consistent growth over the last number of years for the annuity market as a whole, just banking on the higher interest rates and more people entering retirement age.
Yeah, interest rates are an interesting topic. And I guess, as you say, the rise in interest rates has been great for the fixed index annuities. I think we've been able to offer, as an industry, higher interest rates. I think it's been good for the IOL market as well over the last couple of years. We don't really talk. Oh yes, we do talk about life insurance every once in a while on this show. Uh, do you make any forecasts at AM Best in terms of like where that 10-year Treasury rate's going to head? I mean, there's a lot of political pressure, to take rates down, but the 10-year obviously is not set by the Fed. It really is. It's a matter of market dynamics. Do you have long-term interest forecasts as part of the work you're doing?
We don't put out, I guess, official long term forecasts. Obviously, things can change very quickly. Um, so it is more of us analyzing how uh, the clients we rate and the companies we interact with, how they are adapting to that interest rate environment, whether it be from the investment standpoint, whether it be from the crediting rate or guaranteed minimum crediting rate related to products. Um, so yeah, I mean the forecasts are really there. We have a gauge. We do poll all of the executives from the clients we rate at our annual review preview conference, which is usually in late February or early March, towards the beginning of the year. But obviously, the operating environment now is even very different than when we had that conference. That was in the middle of all the initial tariff talk and quite a lot of volatility within bond yields at that time because of a lot of these kind of macroeconomic pressures and dynamics that were changing at that time. Um, so yeah, that's a difficult proposition to be accurate on more often than not on the interest rate side.
Yeah, well, maybe talking a little bit about volatility and the impact on the industry. As I mentioned, RILA sales are up 20%. I get questions, all the time here at the company I'm at now. Why is this? One reason could be, well, most of the RILA sales, are coming from banks and broker dealers. Okay, advisors are more, accustomed to annuities and perceive higher value. The other could be it's that these are just perceived as safe havens from market volatility. I mean, do you have what is your perspective? What does your research say on that front?
Yeah, I mean, in times of more market volatility, you're going to see consumers kind of flock to those products that provide them more protection. So I don't think that's any eye-opening trends there.
Yeah, because I mean, the demographic trends have been a long term headwind for annuities, and it's very it's interesting to observe which type of annuities those the consumers ultimately choose, and I think that those slight bump in the road once in a while, are just an observation that the industry is innovating, the industry is offering more and more solution and products. So I think we're certainly into a new and a dynamic environment. And speaking of which, your research actually breaks down some of those company formation, which 10, 15 years ago you didn't really see. I mean, you had mutuals, you had uh, publicly traded companies, maybe a little bit of fraternals, maybe a little bit of privately, family owned companies. But we're seeing a completely different landscape here, and that was shown in your research. Can you talk about that evolution, mainly of private equity owned insurance and annuity companies?
Yeah, sure. This is obviously a big topic, and you see it pretty much everywhere in headlines between private equity and asset managers entering the business. And this is done through a variety of different ways and strategies, right? Um, well, I guess just to stay back, why are we seeing this? Well, number one, as a private equity or asset manager, it's very difficult to maintain um, top quartile uh, yields and investment returns over an extended period of time, right? So another way that these asset managers can um, improve their return is just to continue to growing their book, right? And one way to do that, obviously, annuity companies have very large investment portfolios and a steady stream of income through annuity premiums. And that dynamic is very attractive for these asset managers or private equity looking to enter that space. They're going to get a steady stream of money. They already have the investment expertise built in house, which some life insurance companies do, but some say mid or smaller mid-size may not have quite the amount of resources or expertise to maybe get into some of the asset classes that some larger peers or these private equity companies may be able to get to. So there could be some competitive advantage from the investment return standpoint for these private equity or asset manager companies compared to some others. But in reaction, in order to maintain competitive offering crediting rates, we are seeing more of these mid and small size companies outsource some or all, a majority of their invested assets, kind of to keep up with the investment returns, maintain favorable spreads, and ultimately remain competitive. But back to the private equity, they could either enter the market through, say, minority ownership type deals where they purchase or acquire, say, a minority share, 10% or less of an annuity company. But part of that deal would also include the insurance company outsourcing a portion or all of their invested assets to this private equity or asset manager sponsor. So they're getting more assets to manage that way. They are also entering the space just by straight outright ownership and acquiring companies. So those are the basically two dynamics that these more outside capital and experienced investment managers are entering the space.
And that's a great segue for my next question on the asset portfolio, because we all know that insurance companies are significant buyers of fixed assets, and the dynamic the dynamic has not changed, but the composition of those fixed income asset portfolios have shifted over the last 10-15 years. Can you talk about some of the asset classes that were maybe more popular back then, and that other asset classes that are more popular today? Like what are some of those trends and those shift of compositions of typical life and annuity asset portfolios?
Yeah, sure. So I think private credit is another asset class that seems to be headlines every single day in whatever news you're reading. So thinking back, 10, 15 years ago, back to the prolonged low interest rate environment, companies were searching for yield, right? They at that time they had liabilities on their books from years ago that were offering higher interest rates than they were likely getting from new money yields, right? So one way to try and bump up their yield is to go into private placements. You get a bump in yield for the additional liquidity that you're going there, but there are protections and covenants. Um, but as private credit supply has increased over the last number of years, we have seen a similar dynamic play out on insurers' balance sheets with investing more in private credit. I'm going to say industry wide, private placements are more than 40% of bond portfolios now. And you look back probably 10, 15 years, it was probably mid to low 20s or so. So there's definitely been a boom. I guess one little sidestep, just to kind of think about also, um, a lot of these chief investment officers now have likely not really seen a rising interest rate environment potentially in their entire professional career, right? I mean, I started at AM Best 20 years ago now, back in 2005. And what, the first 10 or so years of my career were basically flat, low interest rates. And obviously, one of the main challenges in the annuity industry is a rapid rise in rates, which could lead to a lot of surrenders, which, while rates haven't risen that quickly over that short of time, it's been a little bit more of a slow, kind of steady over the last 3 years rise, which has probably helped ease some of the pain in terms of surrenders. Having said that, there definitely has been an uptick over the last 2 3 years as policyholders that have, say, an older 3.5% um, rated policy are now seeing rates, 4.5, 4, 5. Um, and if they are out of the surrender charge period, it would probably make sense for those consumers to drop their policy, get a new one, and reap the benefits of the higher crediting rate. So that's an interesting dynamic, kind of not on the top layer of the industry, but just an interesting thing to think about. That we are somewhat in uh, some uncharted waters, just in terms of the interest rate dynamic that we've seen, that we have not seen in quite some time, and there are a lot of new professionals in the industry that this is probably new to.
Thanks, Jason. To kind of follow up on that and ask, um, taking that example and breaking it down for like newer professionals or what agents should be thinking about. Anything else in the report from an insights perspective that was maybe counterintuitive to what's going on from a macroeconomic, like an unexpected result, or anything that agents should be keyed into in the insights, as far as kind of preparing or understanding something that's coming like differently than what they understand today.
Um, I guess just related to, I guess, back to the private credit and the investment composition that Bruno had mentioned before. In addition to private credit, uh, you're talking structured securities, particularly those that are not commercial mortgage back or residential mortgage back. So you have all these other sort of structured securities, whether they be uh, CLOs, other sorts of bank loans, etc. But those sorts of allocations have also been increasing over the last number of years, and that also coincides with the dynamic of private equity and asset managers also entering the space, some of which are originators of these assets.
Hmm.
So I guess one of the newer things that we have been observing over the last couple years, as more insurance companies are acquired or have these asset manager sponsors, uh, we are seeing that uptick. So that's, I guess, not something that we've really seen, say, 5 years ago and before.
Hmm.
But we now are seeing more of these kind of affiliated, structured investments flowing from the ultimate parent or the asset manager that is sourcing these assets down to the insurance company that they own. There aren't too many companies that at this point that have uh, severely outsized exposures. I'm sure there are pockets here and there. Probably some of the larger private equity companies, you would see some of that. But that is definitely something that our analysts are looking at when assessing balance sheet strength, and the basically the affiliated investment aspect of it too.
So Jason, I have two related questions. First question: if I were a chief investment officer, given that such a huge percentage of companies now are owned by private equity firms or controlled by private equity firms, and so much of our credit now is not being issued necessarily by your traditional banks, but actually being uh, uh, created by these companies. Could a chief investment officer, do anything but increase their exposure in today's environment?
Yeah, I mean, well, I guess I would point to the recent headline that that came out of Brookfield saying Brookfield's looking to reduce some private credit exposure. So, I mean, ultimately, I think that's a large question that we may not yet know the answer to. Back when we polled the executives at our review preview conference, I believe private credit was the number two asset class that insurers were looking to continue to put new money in. Um, so there's definitely still appeal, and companies do still think it is attractive. Supply has still been there, but I guess the kind of overarching question is, as insurance companies has seen their private placement allocations tick up over the last number of years, kind of have we hit that risk tolerance threshold, and where when are we going to start seeing it leveling off or even some pullback? I would think this is definitely a case by case scenario, in terms of what companies and how they envision the private credit portfolio within their overall strategy. But I have to think these are indeed some questions going through the minds of investment managers. I would think that larger companies probably got into this asset class first. So you probably have some mid or small sized companies that may have recently outsourced a portion of their investment portfolio, now getting in. So probably a little late to the game. How that directly impacts them, is probably an open question. But like everything, I would think there's kind of a laddered approach. Some are leaders, some are getting in now, some will be getting in late. But that'll be an interesting dynamic to follow for sure.
Well, and I agree. And I guess the second question is, as you mentioned, it takes a lot of expertise to manage these
Mm-hmm.
products. Some of these CLOs are incredibly complicated. How is how has AM Best changed how they the skills and the type of tools that you're using to evaluate these type of credit risks? I'm assuming this is looking at some of these private credit investments are a lot different than just looking at a typical bond portfolio 20 years ago.
No, it definitely is. I guess I would bring up covenants again. With private placements, yes, you have the crunch on liquidity, being they're not freely tradable, and it's not as easy to maybe get off your books. Um, but at the same time, you mentioned due diligence. Obviously, to go through all of the underlying collateral is a huge undertaking, which I would imagine many mid-sized, smaller companies may not necessarily have in-house, and you're seeing that through the increasing amount of companies outsourcing. Um, I would say default rates on private credit has been less, than on the public side. At the same time, private credit you could more easily restructure, in times of need, so that could potentially, quote unquote, artificially suppress some default rates. I don't necessarily know how widespread that may be, but I'm sure that dynamic is out there to some extent. Um, in terms of, I guess, specifically private credit, we do look at exposures to capital, particularly below investment grade private credit. If all of that were to happen to be written down in one fell swoop, how much of your capital would that impact? Right. That's ultimately what our analytical teams are looking at. As that moves into being financially sound and their credit worthiness. Um, but each within our best capital adequacy ratio, our BCAR, our analysts do thoroughly look at the investment portfolio and make adjustments, as they see fit, necessarily for the BCAR, and how some investments may get charged versus others.
So if I summarize a little bit. 15 years ago, you had a lot of private credit that was funneled through defined benefit pension plans. Those are, barely exist anymore. Some of those assets are making their way still to the baby boomers and the retirees through annuities. Any other notable asset classes that have gone through that path of making their way to retirees indirectly, through annuities, but making their way directly through insurance asset portfolios?
Yeah, I think commercial mortgage loans is probably another one. If I'm not mistaken, I believe commercial mortgage loans are about 14 to 15% of the life annuity industry um, investment portfolio as a whole. Um, and obviously, there's been some noise in the CML market as well, particularly after COVID and
Hmm.
the economic ramifications as a result of that. Obviously, I'm thinking office space as well as some retail. Um, so insurers have been trying to get out of the office space for a number of years. We've seen allocations continuously decline when looking at diversification by property type. And kind of in its place as they've been pulling back away from office spots, you have seen an increase in residential mortgages. Um, I'm thinking like offices as well as condos. And you've also seen not as much, but an uptick in industrial type properties as well. Uh, but we've also seen an uptick in problem loans, which would those that are 90 days overdue, that have are in the process of foreclosure or being foreclosed, um, as well as those that have been restructured. Definitely over the last year and a half to 2 years, um, we have seen those problem loan levels rise higher than just by pure dollars, but higher than anything I could recall over the last 20 years. At the same time, I would note, I think it's very important that these problem loans still only account for less than 1%, less than 2% of surplus. So while there may be some pockets of specific insurers that may have some heightened exposure, industry wide, we haven't seen um, exposure to be anything that notable to date, anyway.
Because these things always make the headline,
Right.
and that's usually, the catalyst for the conversation, for the article, for the headline. But on that note, can you put some boundaries or some framework around those portfolios? Yes, there has been some significant changes, but by and large, my understanding is that those portfolios are still dominated by high quality bonds. Do you have some sort of framing of that change over the year, that those asset portfolios are still, of fairly high quality? You mentioned some of the metrics that you use to look at those and to analyze those. Do you have a way to kind of frame, to kind of put into perspective, should I say, those changes that were notable, but that those insurance company portfolios are still, by large, fairly conservative?
Yeah, for sure. I mean, bond portfolios still make up the vast majority of total invested assets. Um, they're largely investment grade.
Right.
Over the last decade, we've seen a shift down a little bit from, say, like NEIC one bonds down to NEIC two, but still within investment grade. Um, so that shift has kind of been there on top. I think these more kind of notable, excuse me, these more notable shifts that you're seeing are a little bit more so on the margins than anything else. Alternative assets would be another one. Schedule BA, we're seeing more partnerships with some, maybe say like tech firms, or something that maybe the insurance company could utilize within their operations, right? So they form partnerships with certain fintech companies, and kind of things like that. But again, I don't think these shifts individual of themselves. Um, some make noise, like you said, and you see that in the headlines. But when taken all together, um, like I said, I think the shifts are a little bit more on the margins than anything else. And again, every company is different. So some company may have more exposure than others, and I'm kind of just talking more
Yep.
industry wide that we generally see.
Yeah, it's um, I guess if we were looking at that industry balance sheet, Jason, I would have expected commercial mortgages to have created a huge issue for companies. I think the truth is the market's kind of worked its way through this process. I think my sense is there are a lot of landlords who've restructured, and lenders who've restructured their uh, contracts based on market conditions to avoid defaults. But if we looked across if you looked at the balance sheet in as a whole, and I'm kind of asking, I think the same question Bruno was from a little different direction. Where is the biggest risk today? Doesn't sound like it's commercial mortgage loans. Is that fair to say?
Yeah, I mean there's, I guess, some pockets, right? Commercial mortgage loans, I guess specifically, insurers do look for, generally speaking, best in class sort of properties. Um, Granted, that's historically been, the the best properties, say in the middle of a city, where occupancy rates will likely always be higher, right? So that's kind of one hedge that insurers kind of look forward to uh, stabilize their portfolio a little bit more. Um, at the same time, um, insurers also really do their due diligence on loan to value and the ability of their borrowers to be able to pay back their loans. So I think uh, the standard and underwriting process in the insurance industry for commercial mortgage loans has historically been tighter than, say, your general bank. Insurance companies can just be a little bit more picky, and as a result, we haven't really seen the same sort of default dynamic in the insurance industry that you saw at, say, banks. So that's kind of another way that insurers have insulated themselves. I guess circling back to your question of where we might see the most risk, um, I guess I would have to think it's more along the private credit line. Historically, private credit has been largely direct lending, direct issue. More recently, say over the last 5 or so years, we are seeing more of a boon in structured type private credit. And again, I think that's just from the lenders and the private equity and the asset manager originators. There's just more supply of this, and that's kind of just finding their way to the balance sheet. But on a company by company basis, our ratings analysts do apply some sort of stress test scenario, just for an additional comfort level of, um, their financial well being of these insurance companies, and how much stress can they actually handle.
Great. Well, thanks for that. And before we leave, I wanted to get into that last topic of reinsurance. Again, 15 years ago, you had a reinsurance landscape that was dominated by a few number of players, highly rated and pretty static. Now, 15 years later, things have changed. You have a lot of new entrants, not a lot of new company formation, different jurisdictions. Can you talk about that shift that happened over the last decade or so of new entrants, affiliates, and various jurisdictions?
Yeah, sure. No, this is definitely another topic that you see quite a bit in news headlines and whatnot. Um, so I guess I would start by pointing out, and we talked about this earlier, just the record annuity growth over the last couple of years, right? Annuity business, as you know, is very capital intensive.
Mhm.
Um, so when companies experience such large premium growth in a shorter amount of time, uh, their capital will be a little bit more pressured. So one way to relieve that a little bit is to utilize reinsurance more. Um, and some of the larger annuity players um, are some of these kind of private equity sort of companies that have larger organizations and subsidiaries, maybe not in the US and offshore, whether it be Bermuda or the Caymans, or potentially some other Caribbean island. So, one way to, like I said, kind of relieve some of the capital stress is to reinsure some of that business to a reinsurer, uh, as we've seen over the last couple of years. And again, in headlines, there's been notable growth in affiliated reinsurance. And again, I would say this is largely driven by even a handful to a dozen or so, generally speaking, private equity or asset manager type companies, such as Urethane and Global Atlantic are probably your top two there. Um, so while this trend within the insurance industry does get um, a spotlight shown on it, it is definitely not an industry wide phenomenon yet at this point. You're not seeing many small to mid-sized uh, primary insurers in the U.S. setting up affiliates in Bermuda, to be able to set up that structure. Again, this is more at these larger, probably more well-known sort of companies that are driving most of this uh, offshoring annuity business to other places. I'd say Bermuda, it has a track record of reinsurance with the U.S. Similar accounting standards. It's a reciprocal jurisdiction. There's a lot more, I guess, talent related to the insurance industry, reinsurance industry in Bermuda. So I think those are probably some of the reasons why that domicile in particular is somewhat running away with the annuity reinsurance market to this point, anyway.
Interesting. Well, first of all, Jason, it was great to have you on here, and we'd love to have you back on a regular basis, particularly as some of these reports come out, because there's a lot of interest in all the areas that we've explored. One last question for you, which is and I don't know if you have enough, if you have insight into this, but feels like every 3 months I'm reading about or meeting a company that's bought a shell company, putting more capital into it, and suddenly, we've got a very active another annuity carrier in here. Do you see that? Do you think we've crested, or do you think we'll continue to see same level of new entrants in the market in 2025 and 2026?
I would we probably have not crested. I would think we're still going to see a continued trickle of new capital entering the market. I guess one point about that, um, I guess just as one view is capital itself does not necessarily equal success for new capital entering the market, right? The insurance business is very regulated, and that needs to be able to be understood. Underwriting needs to be able to be understood. So insurance is more than just capital and investments. There's a whole lot of nuance, a whole lot of regulatory burdens. So in addition to kind of this investment expertise, new capital entering the market needs to understand those regulatory nuances. It's very easy to get into the insurance business, but the liabilities are very, very long dated. So it is hard to get out if you don't have a strategic plan already in place. So that's the main thing I think you need to keep in mind if you are considering entering the insurance industry.
Yeah, it's a very, very complicated business, and I've been on the carrier side, and as well as now technology supporting, some of these newer entrants. So you're spot on. I guess, Bruno, any final thoughts or questions for
No,
Jason?
I clearly want to leave it at it's a very complicated industry. So I think we can all agree we've all seen this industry from various lenses, and if that's a fair that's clearly a fair conclusion and some ground of consensus. So
Yeah.
no, thank you, Jason, for coming. Certainly appreciate it. Continue the research.
Yeah, thank you so much for your time.
No,
Yeah.
thank you for having me, and I hope this was informative
Oh,
for
yeah.
everyone listening.
Oh, yeah, absolutely. And listen, love to thank our guests for listening to our show. Like us, recommend us, and most importantly, come back next week for another great episode of That Annuity Show. Thanks.
Thank you.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.